Hello, everyone, and happy 4th of July. This is our quarterly chart party. Basically, it's an update on what we talked about in January with our outlook for the market, the economy, the stock market. And we're going to tell you what we're thinking today. First of all, talk about what we do for clients, go-to advisor, optimize your wealth, and service with integrity. Let's go to the question of the week. What has changed or surprised you since the January market outlook? I would tell you there's a couple things that have changed. The Iran War, conflict, whatever we want to call it, and also the surprising strength of earnings from the S&P 500. I'm going to talk about the Iranian conflict first. In part two, my son is going to talk about the earnings surprises and what that means for the stock market. Let's talk about Iran first. When this conflict happened, we expected energy to spike. And as you can see by the chart on the far right side, it did spike well over $100. I think $115 is where it got to. Interestingly, that wasn't as high as 4 years ago when the Russia invaded Ukraine. It got much higher. And after that, it did fall down. More recently, if you look at the far blue dot, we are down again. We're back to $67 a barrel, which is not a problem for our economy. And when this happened 3 months ago or 2 months ago, the market did correct 10%, and we told clients this would not be an issue long term. And they said, why? With the spike in oil, won't that slow the economy? Won't that hurt the stock market? Well, it did briefly. But if you look at the fundamentals of energy in the U.S. and how less we rely on it today than in the past, you understand why we were confident this would not be a problem. And let's look at this use. Good example. Real GDP in the U.S. has grown 40% in the last 20 years. Look at this chart. Gasoline consumption down. Why? Cars are more efficient. We use less energy. Just overall, everything is run much better. It isn't as important as it used to be. Why is that? One of the reasons is we're not reliant on manufacturing like we used to be. You look at this chart over the last 70 years, manufacturing has gone from a quarter of our economy to 10%. Manufacturing, like making cars and steel and everything else, takes a lot of energy. Making software and cell phones do not. So it's just not that important. And this trend has been in place for a long time, which is good news for us. The other thing, we don't import a lot of energy anymore. Thanks to the fracking revolution, we actually are a net exporter of petroleum and related products. You look at this chart back in the 70s, when energy spiked, we were importing 3% of GDP. Growing at 3% is a lot. This was very much a struggle for the economy. Even in 07 and 08, a barrel of oil reached $145 a barrel. It was much more difficult at that point. But again, thanks to fracking, it just doesn't mean as much. So all those tankers that were stuck in the Straits of Hormuz, it didn't matter for the U.S. economy. Again, good news for us. If you look at the long-term inflation-adjusted price of oil, you will find that, quite frankly, it's cheaper today than it's been in a long time. The dotted line is $100 a barrel. We're back to 67. So yeah, the spike in the 80s, the spike in 2008, 2009, it was a drag on the economy. Today it's 67. It's just not a drag, and we use less of it. And why do we use less of it? Well, because we're more of a service economy. By the way, manufacturing, interestingly enough, when we were asked about energy hurting the economy and manufacturing, this is the ISM manufacturing survey, when it's below 50, manufacturing is contracting. When it's above 50, it's growing. Before this conflict, we had about 2 years of contraction in manufacturing. Again, it's only 10% of our economy, so our economy still grew during this. It's the other parts that grew. By the way, we're back at above 50 and manufacturing is picking up, so that's very good news for the economy. What drives the economy? It's mainly services. Services is 60 to 70% of the economy. And guess what? The services survey shows we're above 50%. We're in growth mode in the services. We got close to contracting a year ago and a couple of years ago, but manufacturing now is positive and services are positive. So when we look at this on its whole, it's very positive. In fact, most of the estimates we've seen for GDP in the third quarter have gone up. So we feel confident. As we said in the beginning of this year, we thought we would have a good growth year in the U.S., GDP of 2.5% or better. We still look on track for that. And that will bode well for the stock market. So right now, not a problem. It was a surprise, much different than we expected, but it has worked out pretty much as we thought it would. Great news. In part 2, we will talk about what this means for the stock market. And again, the big surprise there is earnings. They're just much better than we ever expected. Thank you for joining us. We'll talk to you again soon.